Hi, everyone. I'm Gunjan Banerji.
And I'm Telis. Welcome back to another episode of WSJ's Take On the Week. We've got a busy show today. We're going to talk government unshutdown. We're going to talk economic data, or are we? TBD. And we're going to have a big conversation about AI, not from the stock market point of view, but from the bond market point of view, which I think is going to be a big story in 2026. And speaking of which, we'd like your help, listeners and audience, for our upcoming episodes. We'd like you to send us a question about what you think will be the big topics and questions in 2026.
We want to hear what's on your mind right now as we head into 2026. So if you have a big question about markets, finance, the economy, we want to hear it. So send us a note at takeontheweek@wsj.com.
Or drop in something in the comments in your venue of choice.
So tell us, it seems like the government shutdown is over.
It is officially over in the sense that the Senate, the House, and the president have all agreed on a legislation to keep funding the government. But is the economic impact over? I think that's the big question for markets. Whether or not and how quickly SNAP benefits, those food stamps, government assistance, come back, because that relies on states kind of restarting those payments. Economic data. When are economic data reports going to start coming out? When will we have updates on inflation? Are there going to be periods of time where we just really never know what the official government answer was because there was no one there to collect that data? I think that is still TBD and is certainly something that markets are going to be looking for in the weeks ahead. Then, of course, the can that was kicked as part of this agreement was on subsidies for the Affordable Care Act market. The Democrats want a vote on that. Republicans are promising a vote by December. We'll see how that all works out. But again, that's a big economic uncertainty for a lot of people who participate in that market. And of course, the resolution only keeps the government funded until January. So we'll be here again in this seat in 2026. There's one
Sounds
thing,
fun.
one 2026 story. But what do you think? Do you think the market is ready to resume its upward ascent now?
Yeah, it's not clear to me how much the shutdown has impacted markets. Even though we haven't gotten jobs data, we haven't gotten inflation data, we don't really know when we're going to get that data in the coming weeks because the government hasn't been able to collect that data during the shutdown. But it's fascinating to me. The Journal recently had this piece about how despite this lack of economic data, one thing that's making people feel quite good about the economy right now is the fact that stock prices are going up. And, the record dash that we've had in equities has boosted sentiment among many Americans and made them feel more bullish about the economy. So it's kind of a reverse feedback loop, right? I think a lot of people think of the stock market as this indicator of the economy, but it's actually become something that's driving how people feel about the economy because people have such a large exposure to the stock market these days.
Well, there you go. You're doing something patriotic every time you buy stocks and send the prices up higher.
We've talked about this a little bit before, right? But I think it's important to put some numbers around this wealth effect. And, for every $1,000 that your portfolio goes up, that can boost your spending by, say, $30. So there is a direct impact there.
There's one group of people, though, who seem quite uncertain, and they're very important, and that is the Committee of the Federal Reserve, the Open Market Committee of the Federal Reserve. WSJ's chief economic correspondent, Nick Timiraos, kind of the Fed whisperer, what he's been writing is that there's really less certainty than ever and less agreement than ever. And the lack of economic data has not helped.
Of course.
It seems like there's a really wide disagreement, and you have people who feel like we've already pushed it enough. You have people who feel like we haven't gone nearly far enough. So that getting economic data will be critical, I think, to making a Fed consensus and then therefore giving investors some sense of where interest rates are going to be. But until we're past that, I don't think the market's really going to have the fuel to rally significantly. That would be my expectation for the next few weeks.
It feels like the economic outlook is unusually murky heading into 2026, especially with this data issue.
Another thing that's really going to hold the market back, I think, is that we seem to have hit, at least for now, some kind of ceiling on the AI trade.
Huh.
A couple of weeks ago, we had a pretty significant fallback in a number of AI stocks. Nvidia, I think, one day fell 7%. Those have come back a little bit, but our colleagues, Dan Gallagher and Asa Fitch, recently took note of all the price equity ratios of the big kind of AI tech Mag 7 companies. And what they found that not one of them was trading at the high valuation level. So it seems like investors have started to peel back some of those bets. And the big uncertainty that's hanging around those AI stocks is the expenditures, the spending. But Gunjan, I know you look closely at retail investors and kind of talk to a lot of different investors. What's your sense of like how the AI trade is doing at this very moment?
I think people keep piling in. I mean, people keep piling into the stock market, right? Even over the volatility that we've seen over the past few weeks, US fund flows have still been really strong. And a lot of that is dependent on big tech.
Well, the question is, how much more does this trade have to go, and how much more money is it going to put in people's pockets? And of course, we have Nvidia earnings this coming week, which are an event not just to talk about Nvidia's numbers, but to talk about what's going on with the AI economy. And interestingly, we did see the giant Japanese investor SoftBank sell a big chunk of its Nvidia stock recently, and actually to fund a bigger investment in OpenAI. So it's in that sense shifting some of its bet from the chips themselves to the applications like ChatGPT, which is what OpenAI makes. So that's an interesting trend that I think people are going to be wondering, where is the money heading just within the AI trade? What stocks might benefit from here? Maybe it's less chip makers and more applications. So the AI trade might continue, but what form it takes might be really the big question.
And what does it look like in the bond market?
Well, let's lay out some of the numbers that I think people need to wrap their heads around when it comes to financing. You flip through analyst notes from, big banks, you see numbers like, price tags for the AI build out. And that includes not just the data centers, but the power, the chips, everything that goes into it. 3, 5, 7 trillion. And even though tech companies are very big, rich companies with lots of cash, that's so much money that even for those companies, it's a question mark of how they're going to get there. And so you've seen a bunch of different things happening. You've seen these what people call kind of circular financing deals, where if you want to buy chips from me, why don't I lend you some money? And then you can do that. That might be a nice, cheap way to get some debt. The person who wants to sell it to you might be willing to lend to you at a low rate, but that's also kind of a wonky arrangement that raises questions of, okay, is this bubble just fueling itself? Is it profitable for companies to do this?
Right. And it's also stoked a lot of comparisons to what happened during the dot-com boom.
So it looks like there's going to be a lot of other financing that's needed. And one of the places that companies will be getting that from is the bond market. And by the bond market, I mean really like the mainstream, what they call investment grade or high grade bond market. And so that's the market that probably will fund a good portion of this because that's one of the biggest credit markets in the world. Again, the numbers there are quite big. You have JP Morgan saying that they think the high grade markets could absorb $300 billion of AI and data center related paper over just the next year. They think that that could be $1.5 trillion of funding from that bond market over the next 5 years. And so the question is, what does this mean for bond investors? That there's all this new paper, as they say, coming their way. Is that good for them? Is that a lot more stuff to invest in? Or is the same worry that's been the conversation about stocks, the S&P 500 is basically just a big bet on AI. Is that going to happen to your bond funds as well? And is that a good or a bad thing?
Well, they say the bond investors are the smart money, right?
Well, and so we called one of the smarties in the bond market. He's a fixed income guru, I dare say. His name is Guy LeBas. I had a conversation with him earlier this week. He is the chief fixed income strategist at wealth manager Janney Montgomery Scott. We had a wide-ranging conversation about AI bonds, the bond market, what does the Fed and interest rates mean for all this, and we're going to have that conversation after the break. Welcome back. We're joined by Guy LeBas. He is the chief fixed income strategist at Janney Montgomery Scott. Guy, welcome to the show.
Thank you for having me.
So, Guy, why don't you tell us about what's going on in the credit markets with AI? Is that having a big effect on things like bonds the same way it is on stocks?
Well, we talk about AI oftentimes in today's financial markets. I really want to recast that a little bit and describe the concrete need for building and investing stuff as data centers writ large. And it's not just the AI oriented companies or software companies that are using the storage, but it's corporations too, who are seeking to have their data co-located with some of the processing power to speed things up.
Tech companies, usually you think of, their main asset are the people who work for them and the things they code, right? But now it's kind of about physical assets too, having those data centers and the computer processing necessary for AI. That's a
Yeah.
big change.
There's a physical location where this data is stored and kept, and that physical location requires all sorts of construction infrastructure.
And so, even though tech companies are known for having lots of cash, at the scale of the investment they're talking about, right? Some estimates are, let's say Morgan Stanley analysts recently said they foresaw like a $3 trillion sort of financing need for AI by 2028. And they thought that, cash flow could maybe meet about half of that. So that leaves $1.5 trillion. And a lot of that might come from the bond markets, the markets where you and I and pension funds and everybody go to buy the corporate bonds that provide that yield part of our portfolio. So, what's it doing to the bond market to be seeing and anticipating all of that issuance?
So the issuance within what we traditionally call the bond market, meaning intermediate to longer term bonds that are purchasable as you referenced by individuals, by corporations, et cetera, that's relatively recent, right? So I think we need to go back a little bit to kind of the origins of the cloud build out, 2010-ish to 2015-ish or so. Originally, these physical locations where data was kept in companies like what we call today the hyperscalers, they were often built by REITs, real estate investment trusts, and there's a handful of them. For a brief note, I may refer to companies from time to time, but they're really just as examples. I'm not advocating or advising that one company isn't somehow better than another. But just for sake of example, Google might go rent space in one of these data centers. And eventually, these projects became large enough that it was significant enough for Google and all the other hyperscalers to stop just renting them and start creating their own spaces. Then in 2019, there was a kind of esoteric accounting change, which basically said that anytime you have a long-term lease, when you're leasing space or leasing a data center in this example, you need to bring it on balance sheet.
On balance sheet, like they own it, they're responsible for the debt, it's their asset.
And so this change in accounting regulations spurred a change in financing as well. So gradually over time, from really that 2019 lease event all the way through today, 2025, these big tech companies have been gradually bringing data centers onto their own balance sheets. And that means borrowing money, right, in order to finance them.
And you tallied up recently. You said that if you kind of extended the recent deals that we've seen from Meta and Google across the sort of hyperscaler, so-called hyperscaler sort of AI companies, that would be maybe a 20% increase in the size of the investment grade bond market, the kind of the main high quality corporate bond market. That's a pretty huge extension of the size of the bond market. What does that mean as an investor if just the size of the bond market is growing so much?
Yeah, it's a really big shift. In an average year right now, there's about, very round numbers, $800 billion of new financing. And that means new borrowings in the bond markets. And so if we just extend those hyperscaler numbers to issuing debt every 6 months, we'd be talking about 20% additional, in addition to that $800 billion of new money. So in other words, the U.S. investment grade bond markets, instead of growing by, call it 4-ish% a year, would end up growing by 5 or 6% a year. It doesn't sound like that much, but we're talking about a net 150 to as much as $200 billion of incremental demand for borrowing. And somebody's got to be there to lend it.
Let me just see if I take your point though about lending. Like you mean people are buying bonds, right? Interest rates are relatively high. The yields on them are higher than they were in previous years, perhaps. And there's a lot of people who essentially want to lock up those yields for a long period of time. So there's enough demand to meet that supply.
More than enough demand. And arguably, there's not enough supply, right? So as a result, today, the additional yield that investment grade bonds pay compared to government bonds is pretty narrow. But if supply and demand come into balance, and maybe, hypothetically, the markets get oversupplied from AI issuance in a year or two, that could cause spreads to widen and the markets to underperform because supply kind of overwhelms the demand.
What does that mean if I'm an investor? If you say spreads are widening, meaning that the yield that people want to own a corporate bond versus what they would get on a treasury is is more. Now, I guess if I'm buying new bonds, if I'm just coming into the market, maybe I like that. But what if I already own bonds? How would you say this shakes out for your typical kind of corporate bond investor?
So I'll take your second point first. If I currently own bonds and spreads widen, that means that bond that I own is not going to perform as well, right? The nice thing about the bond markets is they do well when absolutely nothing happens. Makes lives for people like me a little bit boring sometimes, but that's kind of like what we like to see as strategists and as fixed income portfolio managers. We like to see not much happen. And so if nothing happens, spreads remain flat. We get to collect our coupon. We go home. We have a nice dinner. Now, if spreads widen, the market value of that bond that we own, which has seen spread widening, it declines relative to other stuff within the
Right.
bond markets. So it's not the number one source of returns within the fixed income markets, but it's an important one. And it's one of the biggest determinants of credit, meaning corporate bond market returns.
But what about the credit risk implied by these bonds? Are there any risks that as an investor you're thinking about that it might be different for companies financing AI? We talk a lot about whether there's an AI bubble. Are people over optimistic about the demand for AI? And what would that mean for bondholders if, say, the AI kind of revolution doesn't turn out to be as advertised? Is there a kind of credit risk that people should be thinking about here too?
Yeah, that's an excellent question. So I'm going to separate it out into two pieces. One is going to be the financings that many companies have issued to complete prior data centers, call it before 2025. In many cases, what these hyperscalers have done has been to partner with other entities to co-own and co-borrow on a data center. Generally, where they've done that through is private lending. And these private lenders, they take a range of investors' money and pension funds' money, mostly institutions, but some individuals, and they provide for loans. And in the case of many of these, the data center or the entity to which they're lending to is sort of a standalone project. And if that project does well and becomes useful to its sponsoring company, that's wonderful. If it doesn't, well, then you've got sort of this asset that might have credit problems down the road and not have a lot of use to its end sponsor. And then maybe there's some questions that this thing, this unit, this joint venture, this lending project could fail. I think those risks are pretty modest right now. Now, the other piece I wanted to mention briefly is what we call the unsecured borrowing from a company. So when a hyperscaler goes out and uses its own creditworthiness to borrow in the bond markets, generally that's called an unsecured loan or an unsecured bond. Basically, the company promises to pay it back. And so that portion so far is pretty small, but hypothetically, that could be what's growing in the coming years. And
Interesting.
it really could change the profile of the corporate bond markets by quite a bit if hyperscalers are genuinely issuing 100 or even $200 billion a year of borrowings, because the markets right now don't have a lot of tech companies in them. But if that is the case over multiple years, all of a sudden the corporate bond markets would end up filled with tech borrowers as well.
Yeah, tech companies generally haven't been big borrowers just because they've been so profitable, they've generated such enormous kind of cash flows. What would it mean if the bond market started to feel like the equity market? I mean, we talk all the time about the concentration of the stock market in big tech companies. Would that be something problematic for investors, or like the stock market, would people just sort of say, "Well, that's where we want to be. We want to be in these big tech companies."
Well, ironically, the bond markets already have a pretty big concentration in one industry, which is banks. So
Okay.
banks have been prolific borrowers in the bond markets for practical reasons for decades. And they do represent about, round numbers, about 30% of the U.S. corporate bond markets. Tech companies represent in the 7% range. So again, hypothetically, if this trend of borrowing from tech companies continues, that portion could double pretty readily. And so ironically, you'd probably have a little bit more of a diverse corporate bond market. It would be a little bit less concentrated in the banks like it is today.
How would you sort of talk to an investor about how to think about these markets over the next years ahead as tech companies really begin to take take their rightful place in the bond market as bigger issuers?
Right now, it's not that big of a concern. And the reason is that pricing in the corporate bond markets, we kind of think about it as individual companies and maybe a little bit as industries, but mostly broken down by credit ratings, right?
Hmm.
So whether an issuer is a tech company or say an industrial is arguably less important for their pricing than whether they are rated AA or triple B. If we look at where corporate spreads have trended, right now they're historically pretty tight. They're in about the 11th-ish percentile of all history. So
Wow.
for that reason, we don't think the corporate bond markets are very attractive right now. But if there is an increase in issuance and spreads widen to call it about the 30th percentile of history, which would be about 90 basis points, 0.9% over government bonds, that would be moderately attractive.
What role does the Federal Reserve play in these dynamics? We know that interest rates set by the Fed are, on the relative high side right now, but coming down. We've seen cuts. People are anticipating more cuts. What does it mean for the bond market and for issuers if the Fed is cutting as people expect right now?
As the Federal Reserve lowers their target for overnight interest rates in the market writ large will generally come down, all else equal. So when interest rates come down, that benefits bond prices today. It's not specific to corporate bonds or treasury government bonds or high yield bonds. It kind of benefits everything.
So if the Fed cuts, does that make corporate bonds more appealing?
Yeah, I'm going to answer that a little bit indirectly. So one thing that for sure the Federal Reserve lowering interest rates does is it immediately lowers the income generation on things like treasury bills, on things like money market funds, on
That's like
things
very
like,
short-term money, essentially cash, right?
yeah, things like bank accounts. And so at least on that basis, the really short-term instruments become less attractive. And in general, intermediate to longer term corporate bonds, their interest rates will be more stable. And so it does make sense for sure right now to lock in at least a portion of investment portfolios to intermediate to longer term fixed income, whether that's corporates or treasuries. And in part, it's because the Federal Reserve is in the process of cutting interest rates.
All right. Well, we've got one last question for Guy LeBas of Janney Montgomery Scott after a break. Welcome back. All right. So, Guy, I know on this show we use the word bubble a lot. We talk a lot about a stock market bubble. People can look at the PE ratio of the S&P 500 and decide for themselves if it's historically totally bizarre or if it's justified. What about bonds? How do we know if bonds are in a bubbly market or not?
So I can say that bond prices can definitionally never be bubblicious. Why? Because a bond matures. We know its value when it matures. And so there's no infinite future potential in fixed income. So bond prices can't be in a bubble. Bond quantities, meaning like the lending in markets, can be in a bubble. And we saw one in 2005 through 2007.
Is there a way, though, for the stock market bubble to find its way into the bond market as all these tech companies are coming to market? What might investors ignore certain risks or not ask for enough yield on AI related bonds because they have such firm conviction in that maybe those bonds become like really not sort of a good investment?
So there's a world in which all the borrowing from hyperscalers and AI companies really gets big, and then those investments don't pay off, and then there are problems down the road. As far as borrowing for the AI expansion goes, we are in the maybe second inning. So we've got a very long way to determine whether there's bubble risk or not, and it's not visible from here.
All right, so it sounds like you're saying maybe we should table some of that bubble talk when it comes to the bond market. But what is it that bond investors should be thinking about as all these tech companies kind of enter that part of the market to finance the AI revolution?
I think the most important thing, and this is for the economy writ large, not just bond investors, is whether this investment is both economically and financially, but also societally productive. And that last one, I think, is a particular question mark. There have been no shortage of discussions about the economic and social value of AI for the long run. I don't know what that looks like. That is far above my pay grade, but that's what I'd be a little bit concerned about.
All right, Guy. Well, matters of philosophy and society. Yeah, I guess that's a topic for another episode. All right. Well, Guy, thanks so much for joining us.
Thank you.
Her question wasn't recorded for some reason.
Exactly. It also it wasn't a question. I don't know. And then there was that one guy. We got that one guy. We got that one guy who saved us.